And I want to welcome you to the North American Expats in France Financial Forum for second quarter. I'm here with Brian Dunhill, who's going to really be making this presentation. Brian, you want to raise your hand? There he is. Okay. Brian's going to be talking about financial planning and cost of living. So it's a really fascinating topic, and he has lots to say. But before he does, I want you to know that we are recording this, and that means that you can watch it again. If you want, you can also send it to your friends, and we're going to post this video on Dunhill Financial as well as on the Adrian Leeds Group YouTube sites. So don't have to worry about anything. You don't even have to take notes. If you want to ask questions, ask your questions in the chat. Just put them in there. And when we get to the Q&A at the end, we're going to let you actually unmute and ask the question yourself. Patty Sadowskis, she's here. Patty, raise your hand. Say hello. She's going to be monitoring the questions, and then we'll pick a few that are the most relevant to the entire group. But when you do put them in chat, be sure that you put them to everyone and not just to Patty, because we all do want to see them. Our next forum, just if you want to make a note, is September 20th. It's the third quarter forum, and we're going to be talking about mortgages. So you might want to mark your calendar for that time, same place, September 20th. On that note, welcome Brian Dunhill.
Thanks so much, Adrian. Good to see everybody. It's always fun to have a nice crowd here for these French forums, and hopefully getting back to France sometime soon. We've all been living this cost of living crisis, so please make it interactive. Please have your questions coming in so that we can make it to the questions that you'll all have regarding this. But we want to really talk about some high-level functions of how this might affect you, how this is going to work, and how you can really plan for that in your future for your retirement, or as you get into retirement. So first of all, we really kind of want to define inflation. Most of you know what it is, but it's the grand schism of what we want to think about. When I was younger, I thought it was quite funny when I talked to my grandfather, and he'd say that he paid more money for his last car than he did his first house. And all of a sudden, I'm here 20 years later, and I was looking at an electric car that cost more than my first house. And so I finally feel like I've gotten to that age where I feel inflation. And somehow Cam came up with this graphic that someplace he can find a coffee, or last year he could find a coffee for $1.85. Which might end up being at Wetherspoons or some other unbecoming place to enjoy a bad cup of coffee.
Where do you get a coffee for $1.85?
It might be one of those horrible American drip coffees that I was reminded of last week. You know, Denny's or Waffle House or something like that. It's not going to be a nice coffee, that's for sure. It's not going to be a nice mosaic, but the importance isn't the cost of the coffee today, it's the difference of the cost over the course of time. So it's the adjustment in prices and the erosion of your purchasing power over the course of time. I don't think I'm telling anybody anything they don't know when it comes to inflation. It's the part that comes over time. But this has been an age-old problem in the Roman Empire and the Egyptian times. It was literally that they would chip off pieces of gold and silver that would actually decline the value of their pieces of silver that they were using as purchasing power. And that was what created inflation. So they were deflating the actual currency, and that caused the increase in the price of goods, because naturally a coin was the amount of gold or silver that you were walking around. During the age of mercantilism, all of this colonization around the world brought about a lot of gold and silver that was brought back, which created even more inflation over the course of time. And one of my favorite times is the Industrial Revolution. Before the Industrial Revolution, believe it or not, 1 in 3 individuals actually worked on a farm. So the cost and the change of cost of food didn't affect us so significantly because it didn't cost much. You just grew it in the backyard. It was the commodities that you'd have to buy outside of that. Now it's closer to 1 in every 163 people in the developed world are actually working on farms. So the cost of food changes significantly and changes our behavior significantly. So this is the modern era of inflation. This last century, a few big wars, an oil crisis really shifted things. But now we're back to the age-old version. And the age-old version is that we're printing money. Everybody's probably been to the usdebtclock.org. Great place. They always add extra statistics that even Cam and I, before this call, we were marveling at some of the ones in the bottom right. I'm not going to concentrate on those. I want to concentrate on one key factor, and that is our total debt to GDP. Now, debt to GDP is kind of like how big of a mortgage do you have compared to your personal income? That would be the equivalent for us as individuals. And this percentage has been scaling up and scaling up, but most economists feel that the appropriate level that a developed country should be at would be about 100 to 105, 110%. The last 2 years during the pandemic, these numbers ballooned up in most every developed market. They got to levels that were closer to 140%. 140% is kind of that value that would be more in line with a Greece or an Italy. Any kind of displacement would derail us to the point where we'd be talking about default. So I think everybody on both sides of the aisle, and there's not many things that we can talk about, Adrian, where both sides of the aisle will agree politically, would actually believe in reducing the debt in some way.
Okay, Brian.
Yeah.
Brian. Okay, you probably look at this screen and you can make sense out of it. Okay.
Oh, sorry.
Okay, it's a monster. And so would you be so kind?
Sorry, I was actually supposed to.
Will you point out just a couple of significant figures so we can kind of like understand what we're looking at?
Absolutely. Thank you, Adrian. Sometimes I get overtly excited about the wrong things here. So that this is where, first of all the aggregate information comes from here. Now, why I zoomed in there and then over here on the upper right-hand corner, we circled it in yellow. That's that total debt to GDP number. That's that 134%. So we have more debt than our gross domestic product in the United States. And that becomes the question of whether we could have problems as interest rates move up or other things dislodge the United States. That's why it's such a big talking point beyond the debt ceiling, whether they could continue the debt. It's just become a lot higher than it used to be. Now, I'm not so concerned about it. I'm going to go back really quick. I'm going to show you a few other numbers that are kind of cool when you break it down. And essentially down on the bottom line, what we're going to see is all of our assets. And if you take all the assets in the United States, it comes out to $187 trillion, right? But our total national debt is 31 trillion. So down on the bottom, second one over, that's all those national assets. Those are national parks, highways, federal buildings, airports, et cetera, et cetera, et cetera, et cetera.
You go back to the big screen because the little screen's hard to see.
Exactly. It kind of falls off that one. Now, why I highlight that 180 trillion to 31 trillion of debt, it means that if we really had debt problems in the United States, we'd have plenty of assets that we can sell off with no worries. The thing is, that debt, there's only 3 ways that we can really reduce it. The first one is we can actually increase our taxes. The second one is we can decrease our expenditures. And the third one is that we can inflate our way out of it. Juncker, an old MEP over in Brussels, who is now the Prime Minister of Luxembourg, once famously said, "We know exactly what we need to do. We just don't know how to get reelected once we do it."
Yeah.
And I think it's a beautiful quote because it's so honest. So we know that nobody's advocating increasing taxes or decreasing expenses. We're going to have to pretty much inflate our way out of this problem. And the problem,
What does that mean, inflate our way out of this problem?
essentially, it's continuing to cause inflation so that the debt costs less. So in personal terms, what that would really mean is if you get a raise, if you make more money this year, right? Now all of a sudden your mortgage, which hopefully is a fixed rate mortgage, is going to cost less. It's going to impact you less than it did the year before, right? So if we can grow GDP and if we can have more inflation that pushes those things up, even though our costs are higher, our debt reduces. And since the first two seem inconceivable to raise taxes or reduce our expenditures, no matter what happened last week in Congress and the Senate, essentially, we know that that's going to continue to be the case until that gets down to a good relative basis. We went through 2 decades of inflation being at 1 or 2%. So if there's any youngins on the call, forgive my southernisms, they're not going to really know what inflation is until the last year or so. But we had significant inflation in the 70s and 80s, and it was combated by raising interest rates, which is exactly what's going on now. And that is exactly what we're really expecting going forward.
What are interest rates at currently in the United States?
So it depends what we're looking at. But if we're, let's say, if we're buying debt, if we're buying, say, short-term CDs under a year, so certificates of deposit from the bank, we're getting 5 or 5.5%. Now, if you're getting a 30-year mortgage, you're probably paying more like 5.5%, 6% on the.
It's half that here in France.
Absolutely, absolutely. But you'll remember, typically what we see is that our central banks go in a certain order. And the US normally goes first. And it's not because they're budging in line, it's because the US has the most impact on the global economy. Mm-hmm. So the US goes first, the UK is the US's lapdog, so they go next. Europe after that, Japan goes fourth, and when China does it, we all call them currency manipulators. So it's always in that order, and that's what we've really seen. The US has increased interest rates the most. Cam's going to fact check me on that, but I think we've raised 9 times this year. The UK next, Europe next, Japan and China haven't touched anything when it comes to interest rates just yet. But that's to where it goes in that order, and we'd expect the European Central Bank to get interest rates to close to those levels that we have in the United States.
Really?
And that's where
it's always been about half.
Always is a short-term parameter because 40 years we've only been going one direction, which is interest rates going down. So when we think about interest rates and what they should be and could be, we should be thinking in centuries, not decades. So that's to where, as long as inflation stays high in Europe, they'll have to continue to increase interest rates, but they're not going to do it as fast as the US did it because they're not going to combat the Federal Reserve.
Okay.
Now comes the good news. You know, I've positioned all this bad news for you.
Yeah, thanks.
But we all knew this was going on. We've all gone to the grocery store. We've all noticed, rents going up or mortgages going up if you didn't have a fixed rate. The good news is that we have certain safeguards, and U.S. Social Security is one of those safeguards. It's indexed for inflation, and that doesn't matter if you're receiving your retirement benefits or you haven't started to receive your retirement benefits. Last year was the biggest inflation increase for Social Security in all of history. It increased by 8.7%, which is wonderful because there's 70 million Americans that are currently receiving Social Security, and it affects you in the same way if you're an American that lives there in France. You just don't get that currency hedge to the euro. You're getting it converted into euros, but you're not getting
That
it.
increases government spending.
It does increase government spending, but I can spend an entire hour just on the money multiplier and why that's probably a good thing, and it will increase taxes because it reverberates around.
Okay.
But we're wanting to say on the cost of living aspects of how we go ahead and control these different factors. Now, this is where you want to be careful if you don't have your overall vantage point allocated to mitigate some of the currency risk. If most of your money is coming from Social Security in the US, this 8.7% might decline significantly if the dollar continues to decline. And remember how I was saying we'd expect that the European Central Bank will get and equalize interest rates in the United States? As interest rates move up in Europe, we'd expect a lot of those funds that are held in the United States to shift back to Europe, which will push up the euro. So this is where the consensus is that the dollar is going to start really moving downward in the next years, starting very, very soon as the US halts interest rate hikes. And
so that means the dollar to the euro, it's going to get more expensive?
We'd expect the euro to become more expensive compared to the dollar. So we expect the dollar to be going down. So the dollar's been going up for 15 years. Now we'd expect the dollar to be going down.
Okay.
Now, you asked this in when we first started. Well, does that mean our French Social Security went up? No. French Social Security has pretty much halted for the last half a decade, which is probably why we see those guys in the streets protesting.
This is not a good promo for France, Brian.
Well,
I object to this.
The reality is it is not going to be the portion that really helps you retire. And if this is the part that you're hedging your inflation risk on, we really need to have a conversation. Most every retirement should be based on a 3-pillar system. And if you're talking to Adrian, it can even be on a 4-pillar system. And when I'm talking about pillars, think of those nice, beautiful Roman temples. The first pillar would literally be your government pension. This is your government pension. Your US Social Security is the government pension. That can make up around a third of it. The second pillar would be your corporate pension. So a 401k back in the States would be your corporate pension, or you might actually have a defined benefit. A lot of defined benefits will have an inflation hedge. The third one will be your personal savings. So if you don't have any personal savings going into retirement, you would be looking at best at living on 60% of what you were making in your career if you have a fully funded corporate pension and you are fully paying for your Social Security. The fourth metric is that you buy a piece of real estate and you pay it off by the time you get to retirement. So therefore, you have a lower cost.
I knew you were going to say that.
Well, we got to give you the promo right there, Adrian. So essentially, we expect this inflation to come down. You can see the forecast numbers by the end of the year. We're looking at 4.6% in France, 3.5% in the US. Whether that will be accurate or not, we'll have to wait and see. But all the indexes are that they're coming down. But we're going to have this new normal of higher energy costs, and that's going to keep inflation higher than that 1 or 2% range that we saw for such a large period of time.
What if we learn how to use less energy?
That will take decades.
Thanks.
The problem being that energy usage is even when you get to more renewable energy, it's the storage of that renewable energy. So, for instance, if you produce a lot of sun like they do down in Portugal and Spain, you're going to actually have an excess of energy during the day, but a deficit in the evenings. So until you can actually store it or ship it, you're not going to be able to maintain that constant energy source. So that's where dirty energies have been used, but France has kept lower than most of the rest of Europe when it came to energy inflation this year, for one main reason. That was because they have so much nuclear energy, and therefore they were able to control their energy costs during.
I mean, I find my energy costs are ridiculously low here in general, even though they always talk about how they're going up, and they freak everybody out. But I find that it's really reasonable. And then, of course, the appliances are designed to be as economic and ecological as possible, which is really great. And now I guess you've seen the DPE ratings where they really are working hard to get everyone's homes energy efficient. So they're working hard at this.
Absolutely, and that helps. It significantly helps. Because energy costs are bulk of what we're actually paying for when it comes to inflation. Now, energy costs was last year's story. That's what kicked up inflation. This year's story of why it's coming down is that food inflation has increased significantly. Now, the main reason that food inflation has increased so significantly is because 15% of that is made up of energy costs, whether it be the pesticides at the beginning or the actual delivery of the products. So we'd expect if energy prices, as they've come off their highs, it will slowly dissipate back into the food market, that they'll quit increasing so significantly. And that's why we'd expect inflation to temper by the end of the year.
Okay.
You looked like you had a thought right on the tip of your tongue.
No, I'm just trying to get to a bottom line, and that's it right there. Why should we care?
Absolutely. So what is the real takeaway that we want from this? Well, the first big takeaway is US Social Security will hedge us in certain ways, but it won't hedge our currency risk. So we need to have an investment portfolio. And one of the best investment hedges is the stock market. It's not directly correlated. And this is a very complex way of actually showing you this. But if you invest in the stock market, you'll see that based on where inflation is and where inflation is going, the majority of the time, we'd expect the markets to beat inflation. So we're going to start in the worst case scenario, which was last year. We had high inflation. It was greater than 3%, and inflation was rising. So in those periods of time, essentially what happens is that 48% of the time the market goes up and 52% the market goes down for that period of time. If we think about that, it really makes sense. Companies will first absorb increased costs before they pass them on to the consumer. Hence, they are less profitable. But if you're running a grocery store, you do that for a period of time, and then you pass on those costs to the actual consumer. And because everything's margin-based, the profit comes back. They might eliminate some employees, et cetera, et cetera. So you see, we've got the big old markation of where we are right now. We're at high inflation, but it's falling. And that's to where 76% of the time that next year, the market actually increases because companies have reduced their costs. And all of a sudden, have you ever noticed that when they charge you extra to fly on a plane for jet fuel prices, they bring them in very quickly and they take them away very slowly?
Well, yeah, because they're making a lot more money that way.
Well, it resonates right through into the stock market, hence why the stock market is correlated to inflation. So one of our big takeaways, you notice in 3 out of 4 of the scenarios, 76% of the time or above, 76, 82, and 90% of the time, the stock market is outperforming inflation. It's only when inflation is high and increasing that it lags behind. And that's a short-term lag. It's typically graded as a 6 to 9 month lag. So what is our main takeaway that we really want is that cash is trash. We don't want to be sitting on cash because it's eroding in value sitting in your bank account compared to those inflation values. We instead want to get that money working for us, whether it be in that fourth pillar by paying down your real estate and not having that extra expense because the real estate will grow in value over the course of time, or having it in the equity markets where it will grow in tandem with inflation or further than inflation, so that you have more purchasing power. You want to have your money working for you in some way, shape, or form. Should we see if we have some questions or some dialogue that we want to get into?
Yeah, let's open this up because I mean the wheels in my head, I don't know if you can tell, but they're turning, okay? Because you know, so many of our clients they, you know, they want to just pay cash. They don't want to take out loans. They're afraid of putting money in the stock market, and I'm not really, you know, I'm not an expert at this to really discuss it really intelligently, but I know basic things about money, and I understand that it makes sense to use other people's money, and I certainly believe in investing. So what you're saying is just backing all of that up. Absolutely.
Absolutely. We want to show the overarching data of why we need to make sure that we have our money working for ourselves. There's this simple rule. It's called the rule of 72. It's a math principle that states if we take the return we're going to get or the inflation that we're going to have, how long it would take to have or double our money. So as inflation historically over the last 100 years has averaged 4% per annum, we divide 72 by 4%, it would equate that every 18 years, our money would have in value if we're not getting any interest. So if it's sitting in the bank, not earning any interest, if you have 100,000 sitting in that bank account, 18 years later, you're only able to buy what would be the equivalent of $50,000 worth of purchases today.
Oh, that's scary.
Isn't it?
Yes.
So that's where we need to make at least 4% on our money just to stay even, just to live in that same lifestyle as we were before. And that's why we need to get it working for us. My favorite comment so far right here in the chat, and then Patty, I'll let you run with it, is Cam saying that we can get that coffee for $1.85 from Dunkin' Donuts. But Cam, you're
yeah, but do you want to drink it?
So here for everybody's sake, Cam is our analyst. He's our lead analyst at Dunhill Financial, and he's here to fact check me so I don't say anything silly. And this is where I have to correct you, Cam, and I'm going to be overtly American. They're no longer Dunkin' Donuts. They're just called Dunkin'.
Really?
That's been for the last year, yeah, because they're trying to make that push towards the coffee initiative. And I feel like I gained 5 pounds just saying that out loud.
Oh, goodness. Okay, so let's open it up to the Q&A. And Patty, you see any that you like?
Hang on. We got lots of Brian questions here, and I'm trying to pick the best one. This is from Lori. Lori, do you want to unmute and ask your question? Is Lori here? If not, I'll go ahead and ask. She wanted to know, what kind of return can I expect in the stock market over the next 5 years versus a CD making 5%?
That is a brilliant question. So the stock market's made up of several components. So I'm going to overgeneralize it and consider the S&P 500, so the U.S. stock market, as one big basket, and then pretty much the rest of global equities and developed markets as another one. Now, in that arena, we expect to have a little bit lighter returns than what we've had in the last 2 decades. And one of the main reasons why is because for a couple decades, anybody that's been listening into our updates, we've been talking about something that's called the Tina effect. There is no alternative, right? So you can't buy bonds, so you might as well buy a stock that's earning a higher dividend, and you'll just have a little bit more volatility because the bonds were just not yielding anything. So all of our portfolios, we had an under allocation to those bonds. Now, like you said, you can buy a CD that's 5%. So pretty much everybody's going to a higher allocation of fixed income so that they have the proportionate amount of risk inside of their portfolio. Now, that being said, the S&P 500 is still expensive. We look at the S&P 500 based on a metric called forward price to earnings ratio. So what we're looking at is what we expect companies to earn versus what their current price is as a multiple. And we take the 25-year moving average, which historically is right around 17. So you're paying $17 to buy a stock that earns $1 worth of earnings in the next year. Now, currently the S&P 500 is sitting just under 18, so it's a little bit higher than that multiple. And we'd always equated that TINA portion to be 1.5 to 2 points above what that rate was. So we'd expect some of that to come down, despite we'd expect earnings to go up significantly. The fourth quarter, we're expecting 8.8% growth on earnings year over year, which is wonderful, because if it was appropriately valued, that could all be encompassed. Now, this all being said, and I know that was a lot to kind of diffuse on you guys to a simple question: what can we expect in the next couple of years when it comes to returns on the stock market? We're expecting a little bit less than what we've historically gotten for the long term. Historically, the S&P 500 has averaged about 10.5% per year. 7 out of 10 years are up. 3 out of every 10 years are down, but that's where it's averaged. We'd expect these higher interest rates, which reverberate into higher cost for companies, that essentially, and the fact that we were at higher multiples coming down, that my assumptions for the next 5 years would be that we would average closer to an 8%, but still on those metrics of 70% of the time the markets would go up and 30% of the time the markets would go down.
I see a question. I'd like Sarah McTavish. Is she here? Sarah, you want to ask your question? Unmute. Well, I'll ask it until we hear from Sarah. It's we're looking to complete and pay for a sale in September. When is the best time to change our money across from US dollars to euros?
I love that question, because I'm going to be able to divide it up between my question, or what part I'll answer and what part I'll ask to you, Adrian, if you don't mind.
Okay.
So from a market basis, I would expect the dollar to be going down longer term. Now to September is not longer term. So there's going to be a lot that's going to happen over the summer months that will affect things in that type of regard. Now, on a bigger financial planning scope, if all of a sudden you can go ahead and purchase your euros now, even if it's on a forward contract, instead of just buying the euros and having them sit there earning no interest, I would advocate doing that sooner rather than later if you don't have that wiggle room to take that risk, because like I said, longer term, I expect the dollar to be going down to the euro. That being said, you move it over to Europe. When you have a bank account in France, Adrian, are you getting much interest on that bank account?
None.
But in the United States, we're able to get a 3-month CD, 4-month CD for 5%, right? So I'd rather keep the money in dollars. So
But you don't really know what the currency's, going to do. Come on, let's face it.
100%. So this is where, Adrian, you have partnerships with several currency companies.
Mm-hmm.
And these companies, what you can do is what's called a forward contract. So instead of buying, say, 500,000 euros tomorrow and have it sit in a bank account earning nothing, we'd rather it sit in the United States and actually earn that interest. But if we want to hedge that risk, we can put, it's normally about 10% down. So on a $500,000, you'd put 50,000 down. That 50,000, when you put it down, you're pre-buying the $500,000 in euros. But the 450,000 that's left is still sitting in the United States until September when it executes.
That is definitely the way to do it. So that you just have to go to our website and click on transfer money. And we have 3 currency brokers that we recommend. And you just have to talk to them about what's called a forward contract, a forward buy.
And I just added a link to the chat.
Okay, great.
I'm loving Hugh's question about CDs and 5%. Do you mind if I take that one, Patty?
Go right ahead.
Perfect. So Hugh's asking, if I invest CDs at 5% now, will I be beating inflation? It's a brilliant question on several dimensions, because earlier in the presentation, we showed that we expect inflation to be down to 3.5% in the United States. So 3.5% is less than 5%. Academically, that is that vantage point. Now, the problem is we have an inverted yield curve. So the biggest risk of investing everything in the short term is the fact that essentially we might not be able to buy a 5% CD come next year, and inflation might not be 3.5%. Historically, a yield curve should be that we earn less for the short term and more for the long term. So this is this element that we're getting more for the near term, and that's a recessionary sign. It's a sign of a lot of potential things that we could spend an entire hour on. So in normalized times, we should earn less on short-term CDs than what inflation is. Right now is the anomaly here. So taking advantage of those anomalies are a great thing. Now, knowing most of the people on this call live in France or are going to be living in France after they talk to Adrian, essentially, the thing you want to make sure that you're cognizant of is that when we expect the dollar to go down compared to the euro, and we expect interest rates to go up with the euro, the timing is, when can we get out of the US CDs that are getting a good yield to get that money into euros to be buying euro bonds or euro real estate, so that we can go ahead and get rid of the currency risk while riding this wave of an anomaly of earning more without any risk than inflation. So that's why I love that question. Thank you, Hugh, for tossing that one in. I hope that was understandable.
Okay, we have a couple of others I quite particularly like. One from Loretta, and she wants to know if real estate investment is a better and safer hedge, especially for retirees.
Do you want to go first, or do you want me to go first?
Well, I think it all depends.
It depends what I answer.
No, it actually depends on the real estate.
Absolutely. Absolutely.
I mean, let's face it, if you're a retiree, you're probably not thinking about selling the real estate you have. The real estate will end up being what you're leaving to your kids, right? I mean, you're going to live in it for the rest of your life, and the kids will inherit it.
So it depends on that utility that you're going to have for it. Sometimes in a rental market in Paris, you'll actually get a long-term fixed rental agreement, which is wonderful. Otherwise, it might be inflation linked, which could be a little bit more harmful. But if you're buying your real estate, you've already prefixed that price. And therefore, if you paid it down, you have lower costs of living during your retirement. So you've hedged that one portion of your overall plan. Now, where I say also it depends is you want to make sure that you have that longevity in that property, that you're going to be living there for a longer period of time. Buying associates some different costs than renting. So you don't want to change your mind every 2-3 years. And
you have to sit with it. You have to, yes. It's a long-term investment. It's not flipping is not going to work.
Exactly. So I think it's one of those aspects that it really depends on your situation of exactly where you want to be and how it fits into your overall financial plan. Instead of it being a steadfast rule of everybody should buy or everybody shouldn't. Most every country in the developed world, the percentage of owners versus renters is about 65%. And yet every single government tries to incentivize people to stay. For some reason, they like the voters that voted them in to stick around. And they always try to incentivize them to stay and to buy. And yet nothing they do gets that number over that kind of 65% mark.
Okay, now there's another advantage though in France, and that is the viager.
Mhm.
Because you can sell your property while you're still alive, in effect, live in it till your death, get a bouquet, a down payment, and get paid every month. So then you're really recuperating your investment in reverse by doing that.
Mhm.
I mean, that's always possible here.
Absolutely. It's a wonderful vehicle for those that don't need that estate planning tool of passing on the real estate to the next generation.
Exactly. Okay. I see another one I like. It's would you be, this is from Greg, would you be better investing in European stocks if you intend to live and retire in France? And if so, what is the ramification on taxes and withdrawals?
So if we're buying European stocks, we can still buy them in the United States. So you can buy what are called American depository receipts in the United States, and it's still considered American stock. So therefore, you go ahead and you get the double taxation treaty that as an American, you're paying American taxes. So that doesn't change anything. What it is that you're getting a little bit of a currency hedge on those types of securities. My preference is if I can get my fixed income in the same currency as where I'm living, that's removing that risk instead of changing those factors. Because when you think of, for instance, the S&P 500, the S&P 500, most all the returns have come from 5 companies this year. And those are your Apple, your Google, Nvidia has definitely been at the top of that list. So it's been your tech sector stocks have driven the returns of the S&P 500. And at this point in time, I think the biggest tech company in Europe is Spotify. And I'm still on the free version, so I don't know how much money they're really making. Spotify is
Unfortunately, I'm not.
It's not that expensive though, is it?
No, but they add up when you subscribe to them, between Apple and Netflix and Prime and all that. Yeah.
Absolutely. But my point on that is that Spotify is nowhere near what a Microsoft or a Google is as a conglomerate. It's a platform. And so it changes the investment groups that we have. So we like to buy in the currency that we live in, but we also want to make sure that we have allocations to the sectors that we need to be in. So we want to be overweight in those technology areas. And now going forward, we're going to be looking at probably going into the banks, but the banks are not distressed in Europe, but they are in the United States. So that's where the opportunity will be. So the currency is one management point, but I'd be more fixated on the fixed income side than the equity side looking forward.
This is just a comment for Cam, who is our tech person back there. I've just learned that our audience is not able to unmute, so that when we're asking them to unmute, they can't. So if Cam will allow that, that'd be great.
I wonder if we.
Okay. Patty, see any other questions you think are good for
I
this?
see a question from Carla that would be a good one for you, Adrian. And you touched on this a little bit. When buying property, pros and cons versus having a mortgage if you can pay cash outright.
Well, you should always use, Brian will back me up, you should always use other people's money whenever you can, especially if the interest you're paying is less than the interest you're getting on the money. I mean, that's basic economics. Wouldn't you agree, Brian?
Yeah, from a financial vantage point, when we can borrow the money, as long as we're earning more money from the money that we're utilizing outside of that, it's beneficial. So, what are you borrowing at right now for mortgage rates in France? They're still quite attractive.
About a little around 3, give or take.
Mhm.
Perfect. So now, if you're borrowing money at 3%, if your money's sitting in your bank account in France, I'm going to say pay off your mortgage. That's silly. But as long as you're making over 3% on your investments by having that mortgage, then it'd be silly not to borrow the money.
Well, plus then you're leveraging. You
Mhm.
can buy, with $1 million, okay, you can buy, and if you only have to put down 20%, then basically you can buy 5 properties with that million, or you can buy 1 if you pay cash.
Mhm.
Okay, and so bottom line is those 5 properties are going to increase in value 5 times more than that one. And you will make a lot more money in the end in terms of appreciation, resale, rentals, whatever. It's leveraging. I mean, you know my story. I actually was able to start with an initial investment of about $40,000 down payment on an apartment that increased in value very rapidly in Paris. And over time, I ended up taking 4 equity release loans to buy 4 additional properties. So based on the initial 40,000, I ended up with 5 properties worth over 3 million. Based on that initial 40,000, 3 of which were generating enough rental revenue to cover all the mortgages. So I'm sorry, but that works.
I'm going to have a question for one of our audience members. She's saying she's getting 3% on her French savings account, lower than the US, but better than it used to be. Lori, where are you banking? Because I know there's going to be a lot of interested people on this call that will want to know what bank account you're at, to be able to emulate that. Because that's the highest I've seen. Bank
I don't know if
Populaire.
Lori, I don't know if Lori can unmute.
Oh, no, but she wrote it in there. Bank Populaire.
Okay, Bank Popular 3% on savings. Wow.
That's wonderful. That's where we should be getting it to.
Banque Populaire is one of the very few banks that will lend mortgages to Americans. By the way.
Perfect. So it's on a livret A, which means that we can only do 49,500 euros, but still, it's I don't think we want to sit on much more in cash in these times for the exact reason that we talked about today.
Okay. I guess we can't find Cam to let everybody unmute, huh?
It's probably a setting that we had to set at the beginning, is what I'm guessing. He's playing.
Okay.
Yeah, I can unmute individuals, I think.
Hi, can you hear me?
Yeah.
Okay, so my name is Susan. I don't have anything to say, but I'm just telling you that he did unmute and people can talk now.
Oh,
Great. Thank you.
Awesome, thank you.
That's great.
Fantastic.
I see a very unrelated question about the 2024 Olympics in Paris and how it's going to affect availability of rentals and also properties available for purchase. Quite honestly, this is from Carla. Your guess is as good as mine at this point. Because of the rental laws in Paris, I already know that we are having a terrible struggle finding accommodations for people. And Anne Hidalgo, the mayor, she talks out of both sides of her mouth, because at one point she really wants she wanted the Olympics and couldn't wait to have all these visitors, and on the other hand she makes sure they have no accommodations, so it's really confusing. As far as available properties for purchase, Paris property prices are really down right now, and but we are not seeing, as a result, we're not seeing a lot of purchase of property, which was very surprising to me, because I thought people would be wanting to buy property in advance of the Olympics, and especially now with prices down. But because of the rental laws, because it's not as attractive to generate revenue, that's why I think that the real estate is down, as well as the interest rates being higher. For the local market, it's more the fact that the interest rates are higher. But it's going to be real interesting to see how this plays out in the end. I think she's going to have to scramble to make sure that people have accommodations. Otherwise, she's going to see them sleeping on the street.
Yeah.
You know, years ago when they had the Super Bowl in Jacksonville, they had to bring in a whole bunch of cruise ships so that everybody could sleep out on the cruise ships.
So they're going to be lined up on the Seine is what's going to happen.
Exactly.
Right? River boats on the Seine. It's not a bad idea. Maybe that's what we need to do. We invest in a riverboat.
Wow, you get out of New Orleans, but you're still going the New Orleans way, right?
I guess that's it. That's what I thought of.
Adrian, a few questions have come in about getting a mortgage as a retired person and the maximum mortgage age in France.
It's really tough. First of all, it's very difficult to get a mortgage for an American, thanks to FATCA. That's first, but they don't want to lend to people beyond the age of 60, and they don't want to lend to people who are self-employed. So it's not easy. Not impossible, but not easy. And some banks have a very high minimum, others do not. And we are doing our best to get access to these, loans and banks. We do have access to a new bank in Paris, but that same bank in Nice won't talk to us. So they're actually based on what they're doing in the regions. Like the regional directors have control. It's really been difficult. So not impossible. And if, I had a young couple on today. Yeah, by young, I'm talking about early 50s. To me, that's really young. Early 50s, both employed, salaried. They're perfect candidates. They'll do well.
And I see a comment from Andre Brown that he just qualified for a mortgage at age 54 and life insurance was required. And that's always required.
Well, that's standard practice.
Yeah, that's standard.
That is not by law. That is just mandated by the lenders who require that a life insurance policy be in place in order to fully pay off the mortgage in the event of death. And that is so that France can then charge inheritance taxes, basically.
The big one.
Yeah.
Oh, Hugh's saying €1,000 per night during the Olympics to get a hotel room. For
Not
Not surprising, no.
Well, I'm leaving. I don't want to be around, so maybe I should rent my apartment.
I don't know if you want to advertise that on a public forum like this. The environment there.
Yeah, I do not want to be in Paris for the Olympics, unlike a lot of people who can't wait to be at the Olympics. But I have a feeling Paris is going to be a bit messy.
Mm-hmm. Absolutely. It'll be fun in a certain way, but it will definitely be packed.
Yeah, exactly. No, I'm going to be on the beach in Nice. So, okay, anything else?
There are Olympic events in Nice too,
Uh-oh, I'm in trouble.
What
Okay.
events are down there? Is it?
I know we have some soccer. And I'm not sure what else, but I know there's events here and in Marseille.
Sailing and soccer is what Jennifer's saying.
Okay.
Here's your fun fact. Did you know that the World Cup started because the Olympics used to have soccer in them, and when the Olympics went to Los Angeles dumped soccer.
Oh, wow.
So America is the reason that we don't have, or we didn't have soccer in the World Cup for a good, I think 30 years or 40 years. And now it's amateur level, or it's the youth league, I guess is what it is. Yeah.
Okay, well, I digress, but I'm totally addicted to Ted Lasso.
Do you watch the finale?
Yes.
Brilliant, wasn't it? I've got my Richmond FC jersey upstairs.
I see a lot of heads bobbing, going, yeah, they're all watching Ted Lasso, right? That is definitely digressing. We have time for one or two more questions. Well, you guys are just like completely knowledgeable and don't have anything to ask. I find that hard to believe.
I promise you we'll have 100 more questions when it comes to the mortgage session next time.
Mm-hmm.
Well, okay, one comment here is that the Tour de France is happening at the same time with the finale in the French Riviera, and that is right, and that is where I'm going to be.
Yep, that's absolutely right. Yeah, the end of the Tour de France.
And another question is, does our company serve all of France? And yes, absolutely. The entire, we work the entire country. It's not as difficult as one might think. Yep.
Oh, so Hugh's asking about more on a commercial real estate vantage point when it comes to international commercial real estate. Now, naturally, with this whole work from home environment, people have been dogging commercial real estate in big ways. The thing is, when you look at some of this commercial real estate, it goes well beyond just office spaces. So for instance, the two big expanding areas of commercial real estate that I find mesmerizing are one, server farms, and number two is logistics centers. You might not think about it, but if you're working from home, where your actual information is held is very important. And those server farms, those real estate values are extremely high. And financial companies want to be right nearby them. So while there's certain segments that are struggling when it comes to real estate, there's other segments that are thriving at this point in time. And I think that's the balancing act of where the commercial side will start to shift. I think everybody's probably bought more from e-commerce carriers like Amazon and the likes, especially during the pandemic. It's no longer a thing for the few. And I would venture to say that developed markets are going to get to the same levels that we have over in China and such, which is in the 40 percentile of commerce being e-commerce. I think it's just an ever shifting vantage point for commercial real estate. Instead of
that a lot of offices in beautiful Haussmannian buildings in Paris are going to revert back to their original their original status as residences.
Absolutely.
And they're beautiful.
You're seeing the shift all over the place.
Yep.
Absolutely. So I had one question here. Leslie says, so is buying property in a more rural area a good investment long-term or a money black hole? Well, I think ultimately it's difficult to get your money out of a rural house. We haven't, even though a lot of people have moved to the countryside, my personal prediction is that they're going to get bored and they're going to come back to the cities now that COVID is over, now that we can live together without masks anymore. Or they're going to be more transient and they're going to keep their countryside, but they're going to also have their city residents. They're going to have both. But the countryside we find is a much more difficult sale in general. So I don't know if that's helpful or not. And we are at 7:59. So we can wrap this up unless there's one last question.
So, well,
or you want to make some wrap up comments?
I'll tackle Sue's last question. Just contact us. We can go through all of the different options for Americans. But if you also look through the series that we'll be sending out the follow-up email, there's whole pieces on exactly how you can invest in the American markets as an American in France. And we can always take care of you on that.
Well, Brian, thank you very, very much for another very informative forum.